Cryptocurrency exchange FTX has filed for bankruptcy in what has been called one of the greatest wealth destructions in industry. The fall of the world's third largest cryptocurrency exchange, founded in February 2019, was even more spectacular than its rise. In January, it was valued at $32 billion. Meanwhile, its founder, Sam Bankman-Fried, stepped down as CEO and saw his personal net worth reduced to a fraction of what was previously estimated at $23 billion. So, what happened? What went wrong, and what does this mean for the cryptocurrency world? In today's video, we are going to talk about the rise and fall of FTX. FTX's incredible rise. The company was founded by Bankman-Fried, a former Wall Street trader and former Google employee Gary Want in 2019. The company has seen incredible growth since its inception, attracting huge investment from Silicon Valley bigwigs. Bankman-Fried, an MIT graduate and the son of Stanford University professors, was known to play the League of Legends video game during meetings. His influence as the king of cryptocurrency had begun to spill over into political and pop culture. He pledged $1 billion to Democrats this election cycle. His actual donations ran into the tens of millions, and prominent politicians were invited, like Bill Clinton, speak at FTX conferences. His company had signed deals with the Mercedes F1 racing team and brought the naming rights to the Miami Heat's home arena. Soccer star Tom Brady has invested in FTX. FTX and Bankman-Fried, as well as his brother, who were also early investors in Semaphore, the high-profile news startup run by former BuzzFeed editor-in-chief and New York Times columnist Ben Smith. Bankman-Fried couldn't be wrong. Sequoia Capital, which has investments in Apple, Cisco, Google, Airbnb, and YouTube, described its meeting with Bankman-Fried as likely an interview with the world's first trillionaire. Several of Sequoia's partners rave about Bankman-Fried following a Zoom meeting in 2021. After several more meetings, Sequoia decided to invest in the company. Bankman-Fried was seen as a white knight for the industry. Whenever the cryptocurrency industry had one of its crises, Bankman-Fried was the person likely to concoct a bailout. When online trading platform Robinhood was in financial trouble earlier this year, collateral damage from falling stock and cryptocurrency prices, Bankman-Fried stepped in to buy a stake in the company in a show of support. When Bankman-Fried bought the assets of bankrupt cryptocurrency firm Voyager Digital for $1.4 billion this summer, it brought a sense of relief to Voyager account holders whose assets were frozen following its own bankruptcy. Bankman-Fried couldn't be wrong until now. The spectacular fall. FTX has agreed earlier this week to sell itself to a bigger rival, Binance, after experiencing the cryptocurrency equivalent of a bank run. Clients left the exchange after becoming concerned about whether FTX had enough capital. Doubts about FTX's financial stability had already grown, despite Bankman-Fried's good reputation in Washington as the public face of cryptocurrency investing. Attention had focused on the relationships between FTX and Alameda Research, a trading company also owned by Bankman-Fried, which has been removed from the internet. Specialized media site CoinDesk reported that 40% of Alameda's balance sheet consisted of FTX FTT tokens. That raised eyebrows among crypto experts as a potential conflict of interest. Media reports suggest that FTX needed to come up with about $8 billion to plug a huge hole in its finances and escape bankruptcy. It was Binance CEO Changpeng Zhao who helped fuel the withdrawals that doomed FTX when he said Binance would sell his stakes in FTX's FTT crypto token. The feud between the two billionaires spilled over to Twitter, where Zhao and Bankman-Fried collectively had millions of followers. The final straw came when Binance canceled its FTX acquisition deal, citing recent media reports of funds from customers in investigations by US regulators. Cryptocurrency world was hoping that Binance, the world's largest cryptocurrency exchange, could bail out of FTX and its depositors. However, after Binance took a look at FTX's books, he concluded that the smaller exchange's problems were too big to fix and withdrew from the deal. Bankman-Fried apologized Thursday, adding that FTX would do everything possible to increase liquidity. A day later, FTX filed for bankruptcy in the US and Bankman-Fried stepped down as CEO. FTX Group announced in a statement on Friday that it has filed for Chapter 11 bankruptcy proceedings, adding that it has begun an orderly process to review and monetize assets for the benefit of all global stakeholders. Chapter 11 is a U.S. mechanism that allows a company to restructure its debts under court supervision while continuing to operate. The cash-strapped company has named John J. Ray as Chief Executive Officer effective immediately. What happens next? Bankman-Fried and his company are under investigation by the Justice Department after the Securities and Exchange Commission. The investigation likely centers on the possibility that the company used customer deposits to fund bets on Bankman-Fried's hedge fund, Alameda Research, in violation of the U.S. securities law. Here are the 5 to learn. Number 1. From trustless to trusted, regulation or reputation. In the absence of a decentralized trustless protocol, centralized cryptographic entitles need to build trust. One path is through regulation, the path taken by US-based Coinbase, the other is by relying on reputation, the path taken by FTX, which is based in the Bahamas. FTX founder Sam Bankman-Fried, or SBF, built this reputation through a combination of sporting events sponsorship, political lobbying, partnerships with political and technology leaders, and savvy marketing. All of this was helped by FTX's valuation soaring. Therefore, reputation-based offshore crypto firms will attract more scrutiny than ever before. Number 2. More proof-offs. There is a long-standing infrastructure of auditors, lawyers, and compliance officers who audit the financial statements of financial institutions, but cryptocurrency, being cryptocurrency, is reinventing the wheel with its own version. The last one is proof of reserves, where exchanges publicly attest to the reserves they have. Recently, Kraken and BitMEX have done this, but there are ways to play with this by borrowing reserves. We are likely to hear about proof of booking, proof of identity, and others. An easier path would be to use this existing auditor infrastructure. Number 3. Crypto does not change human nature. Despite all the talk of uprooting the establishment, cryptography has reaffirmed the human desire to make a quick buck by any means necessary. FTX is just the latest in a long line of crypto scandals, from Mt. Gox to Earth Moon to Three Arrows. These, in turn, share parallels with other debacles such as Lehman, Enron, and the South Sea Company since the 18th century. The details of FTX may differ, but it shares common ingredients for human-led scandals such as inflating the value of balance sheets, tactics to increase the value of stocks or tokens, and smart marketing. Number 4. Centralization scales fast. Decentralization does not. One of the biggest strengths of cryptocurrency is that it is decentralized, trustless, and permissionless. This was intended to provide an alternative to existing financial institutions. However, the cryptocurrency industry quickly centralized while still promoting itself as decentralized. FTX used to be a centralized exchange, just like the other big ones like Binance and Coinbase. Over 90% of crypto transactions are done through centralized exchanges. But why this move towards centralization? The answer is simple. Centralized entitles are easier to scale than decentralized ones. Decentralized exchanges are clunky, slow, and have high transaction costs. In the wild west of cryptocurrencies, centralized exchanges were able to increase the demand for cryptographic assets and transactions, and therefore fees, much more than decentralized exchanges. So all VC money went to centralization, which has a clearer path to monetization. Number 5. Decentralization illusion. But even the concept of decentralization is a matter of degree rather than binary. After all, FTX also had a decentralized exchange, or DEX, called Serum. The DEX has recorded more than $30 billion in transactions this year, but the DeFi protocols have started to withdraw from Serum. How come? It seems that FTX had the private keys to Serum, and investors have lost faith in Serum. Now it seems that other developers have created a new version of fork of Serum with better control. But outside of the centralized governance of many decentralized protocols, we also find that a significant portion of decentralized finance is backed by stablecoins. Most of these currencies, like Tether and USD, are actually centralized currencies. Then there is the dependence of the protocols on the technological infrastructure. When Amazon Web Services, or AWS, a centralized entity, experienced an outage in December 2021, decentralized exchanges like DYDX also declined. With that being said, it's time to end today's video. Press the like button and subscribe to our channel for more interesting stuff.